You are listening to Mining Stock Education.
Welcome to Mining Stock Education. My name is Brian Lenny. Today with me, I have Vukasin Pekovic, mining equity analyst with independent speculator and a private investor. In our conversation today, you will hear Vuk's approach to deploying money in the sector, how he manages risk, his view on the recent Newmont and Discovery Silver deal, and his top picks in the sector. Vuk, it's great to have you. I think let's start off with your approach to speculation in the sector. It's sort of a good introduction to you and how you deploy money.
Hello, Brian. Thank you for having me. I'm really honored. I actually shared a quick backstory that you had no idea that I actually have with you, and you are one of the main reasons that I am where I am right now. So I guess a public thank you is in order to kick things off here. And so if we go, we're starting from let's say from a broader strategic view on the sector, right, and especially on the smaller junior and at the highest risk end of the spectrum, or at the beginning of the Lassonde curve, if you will. And in finance terms, I believe that the proper way to do this is looking for special situations and looking for inflection points inside of the companies, right? And this instantly means that you are employing the bottom-up approach instead of top-down, which may tie, to your macro beliefs or your macro strategy or whatever. But if you do this, as most actors in the sector know, if you do this in the mining sector, you're guaranteed to lose. It's just math. So if you do not do the bottom-up approach properly, you probably won't have a great time. And so pertinent to this, a lot of the early stage investing comes down to effectively discovery investing in the sector, right? And this sounds cliche at this point, but what it actually is just answering a series of unanswered questions, right? And the way I look at this personally is the question that you're asking at a given point depends on the stage and the size of the company that you're dealing with. And when I say stage, of course, it means the stage of the asset that they own fully, or maybe even in a joint venture. Maybe they're a minority partner. Maybe they're the majority. It all depends on the situation, right? But you're basically asking certain questions that, in mainstream finance terms, you would define it as events that are significant catalysts that mainly drive the price of your instrument, which is your stock, basically. And you're trying to get a favorable outcome out of those events, right? So what I personally do is I employ a probabilistic approach once I first define the appropriate questions to ask for a certain company that I get interested in.
Right. So how about metal-wise? Are you agnostic to the metal, or do you have a specific focus?
I mostly am, but I think that as we've seen with lithium in the last 2 years or so, right? I think it is wise not to choose those areas that are so cyclical that once the downturn starts, it becomes almost impossible to, even if you get the bottom-up approach right, you cannot attain the outsized returns if the cycle is against you. And what I mean by this, there's a very simple practical example from recently is Q2 Metals, a company that has made a pretty serious lithium discovery, and the stock just hasn't responded properly, and it hasn't responded nowhere near as, for example, Petri Battery responded once the cycle was in favor, and you could consider it as wind behind your back. So I think, number one, it is important to not be in areas that are so cyclical that, at one point you just think they're going to go to zero. And very pertinent to this, somehow it just, especially in the currently and in the last 4 or 5 years, I think the areas in commodities where we have secular bull markets are just copper and gold. And these are themes that if you just focused on names that are solely focused on these two, with these two alone, you would have more than enough work to do as is, right? You cannot as let's say that you're just a retail investor, you're one guy. There are more than enough companies that you can look at just in copper and gold, and you're going to be pretty busy. So there is, in my opinion, there is no need to broaden your scope needlessly and invest your attention in some things that, even if you do get them right, you risk just not being rewarded because of things that are completely outside of your control.
What about jurisdiction-wise? Do you have places that you just won't deploy money?
If you're talking early stage, then I guess we would avoid things like California and those places that that are likely unpermittable, right? Even if you discover something, the market is going to know that your story won't be able to gain legs, right? And it likely won't get advanced. So places like those, and I think one underappreciated factor with the jurisdictions is the cost to operate there, right? And everybody, I think the entire sector has turned very positive on Argentina on the back of the massive success in the Vicuña district, right? Mostly on the back of that. But I think it is broadly not misunderstood, but underappreciated how expensive and hard it is to work in those places. So why is this important? Because if you decide to speculate on a junior, note how I didn't say invest. If you decide to speculate in a junior that has really, really high operating costs, and if they raise 5 million in a financing, they may have enough money to do 3 proper drill holes. The math is unlikely to go into your favor, and you're just going to end up in a dilution cycle, and it's unlikely to end up well for you as an individual equity holder. But if I may just go back to just quickly take a step back, there's one thing I forgot to mention regarding the materials themselves and the areas, and why I favor copper and gold mostly. Sure, secular themes, secular bull markets are nice, but if we are talking about the let's say left-hand side of the Lassonde curve and the early stage propositions, it pretty much all boils down to geology, right? And if we talk copper and gold, we're likely considering porphyry projects, epithermal projects. If you're lucky, it's going to be a VMS, but it has to be a really good one and a really good proposition. But it's usually just an intrusion-related theme, which is usually a porphyry, or an epithermal, which is kind of very related to geology to that as well. And why I like these situations is they're very well studied, and once you discover a proper porphyry, you have I think you can hang your hat on the fact that you have the tiger by the tail, and you're sure that they're hard to drill off. They require big cores. It's expensive, but bulk tonnage geology is much easier to define than deep, narrow underground veins or anything that is more complex than that.
So you concentrate on these earlier stage companies. You find a good company. The jurisdiction is acceptable. How do you look at entry price or determining value of an exploration company? Is there a certain way that you look at how to compare these or come up with a valuation for something that essentially doesn't have anything economic?
I think there are multiple approaches to be employed here. There are several things to be said. If we are talking about juniors that that own a project 100%, right? I don't think that there is a way to value them per se, but it's more of a pricing method that you base on, for example, maybe on other opportunities that you see in the public market, or maybe some private deals that you may be familiar with. So you're just comparing. First, you take the relative approach and you compare them on a relative basis, right? And so it's just price tag, very simple. Not too much wisdom to it. Then there is, I think this is also kind of relative to the price that you're being offered, right? Because you don't really choose the price, especially as a smaller investor. You look at the size of the prize, right? And you usually want roughly said, I think, things where you can fit a pretty big deposit, right? If you are, I mean, this can be a pre-discovery situation. It can be something that maybe has some historic data or some recent data. There can be really a wide variety of situations, but it depends. Simply put, it depends on the size of the prize, and also, and I think this is the most important part. If you analyze the data that the company is providing, so it is not just a fresh license that is completely grassroots, right? But let's say it is a pre-discovery opportunity that is bound to be drilled. Maybe has some historic holes, though personally I prefer no historic holes at all. So if you're looking at something like that, the most important part, at least for me, is how confident can you be that you're going to achieve success. And when I say success here, success depends on the unanswered question that you are imposing for that concrete situation, right? And again, I'm being a bit convoluted here, but the question that you're asking depends on the price that you're being asked to pay, basically, right? So if you are being pitched on a pre-discovery opportunity at, call it 50 million Canadian market cap, and you maybe see 3 similar opportunities in very similar geology that are already on the market for 10 or 15 or 20 million, why would you be getting involved into something privately that you can't maybe even exit at 50 million, right? So that would be a very, very simple way to do it. In terms of valuing these things, I think I guess I would say that the only very early stage companies in the sector that are quote unquote valuable are prospect generators, because they usually have a cash file, they usually have maybe interest in equity interest in some other private or public entities, and so on. But in terms of juniors that 100% own it, it's just pricing.
Right. Well, let's talk more about prospect generation, because I'm a big fan of it, but not everybody is. I've heard, it's boring. You're giving up too much of the project. A lot of these different arguments against it. So how do you look at prospect generation versus, the regular sole exploration company? Are you more prone, if let's say that the prize is the same size of the solo explorer and the prospect generator? I know there's some ambiguity with pricing here, but let's say you have the sort of same prize on each hand. What do you go for? Do you go for the sole exploration, or do you go for the prospect generator?
So what I would do is, and sorry, we are assuming here that the prize is supposed to be the same, but the prospect generator owns a minority of it, right?
That's right. Yep.
That's a very good question, because it again brings you back to looking at the data that is like straight from the ground. You're literally looking at the rocks and trying to assess the situation yourself. I have to say that I'm biased. If I really like it, I'm very biased to taking the risk on a 100% basis, right? That's just me personally. Of course, there are a lot of good arguments for the prospect generator model, but at the same time, know that I didn't say yes and no to the model. Like I really do not have anything against those companies. But what I believe that has to be said is there is leeway for management teams in prospects, namely prospect generator companies, to just turn that into a not so obvious lifestyle vehicle. And so the way I see this is, if you are just buying a prospect generator without looking, and this is what people tend to do with some smaller royalty companies as well, especially retail parties, is what I've noticed. Without looking at their project portfolio, without looking at the asset one by one, and actually seeing what is there, as you would with 100% in a 100% owner situation by a quote unquote a normal junior, you're basically delegating all of this work to the people who are running that company, right? And this could be just I guess my personality, but the way I see this is, do I really believe that some other people, even who are running that company, are more keen on making money for me than I am, right? And generating returns. So I just don't like delegating things that are very that I'm very picky on and picky about to other people. So this is a part of part of my hesitancy towards prospect generators, right? The positive part of prospect generators, in my view, is that if you look at, and I think we have heard this analogy a lot of times, if you look at the junior sector as a bunch of options, right? Like every company is basically like an option with an expiry date, and the more cash a company has, or the more time it has to test the targets that it shows to you, the better, right? Because you're not going to get the farther time to the next round of dilution is. So if you look at it on that basis, then prospect generators look a lot more favorably compared to the 100% owned opportunities, because simply put, again, in option terms, the theta is longer, right? And so you're not going, hopefully you're not going to get diluted inside of, let's say, a 3 to 5 year period, while again, hopefully a serious discovery is being made. But actually, I mentioned a couple of hypotheticals here and examples, but from my end, and to answer your question pretty clearly, what I would do is, if I were looking to buy a prospect generator, I would have pretty much the same reason that I would have with just a normal junior, and I would look at their ideally you would look for a prospect generator with a flagship project that also has some optionality on the side, but you are focusing on that flagship asset, and you are seeing it as the main driver for the value in that company. So in practical terms, I think it would boil down to analyzing it the same way that you would do a regular junior.
Right. So like some of your answers, I think, would have already sort of touched on risk mitigation. And I think that's what, for me anyways, that's what it comes down to for liking the prospect generation companies, is that risk mitigation, even on these targets that are exceptionally good. I've just seen so many of them fail that that's sort of where I've come to in my process. But how do you're definitely looking on the riskier side of the Lassonde curve. How do you specifically go, consciously mitigate risk in how you invest?
The very first answer to that would be a simple one. It is position sizing. And what I mean by this, I don't mean like have 20 or 30 positions and then end up not having a single clue what is actually going on in your portfolio. What I mean by this is, and I'm repeating myself again, is employing a probabilistic approach. And again, this may seem like a vague term, but I have a very concrete example for one of I would say legendary investors in finance, right? And that's Howard Marks. And the way he defines risk. And throughout the years, there has been a lot of content consumed from the mainstream finance industry, and actually tried to employ into what I'm trying to do, right? And the one thing that extremely resonated with me from Howard Marks, and there is a recent video actually from Oak Tree Capital with him, where he mentioned some very, very basics in probabilities and stochastic processes in that video. But and with an engineering background, I really appreciated this. But what he says, and these are qualitative statements, the way to define risk, and this is the takeaway from the video, the way to define risk, actually the risk is defined on a basis of subject matter expertise. So you're not really able to quantify risk by seeing it as maybe volatility in the instrument that you are investing in or trading. You actually need an expert for a certain subject that is going to tell you what is the actual probability or assessed probability of losing money, right? And when you boil that down to your investment strategy, if you assess those probabilities properly, you are going to size your position based on that, based on those probabilities that you assessed. And if you did the right assessment, i.e., if you are a good expert, right, you're probably going to do well. And what I mean by this, like in very hands-on terms, assessing risk is, first of all, what is the downside? And in this 50 million, for example, 50 million Canadian pre-discovery example that I mentioned, if you're a small investor, you actually at that price, you actually run the risk of still having a pretty big drawdown on that position, which is maybe even 30% plus from that level, if your key drilling program maybe fails, right? And so based on the risk assessment that you provide for yourself, and the way I do this, I actually have it's not that small at this point, but I have a database of projects and companies that succeeded or failed in the past that I use, and compare the geological data from those early stage targets to something that might be on the market right now. So what this entails, of course, you compare the numbers, you compare the methodology with which the target was generated. You compare, and this is very key. You compare the places where the projects are, because different numbers in the targets. For example, if you have copper soils, different numbers can mean different things in different places. As an extreme example, for example, in the Carajás district in Brazil, and I'm sorry if I'm digressing here a bit, but I find this pretty interesting. An extreme example, for example, in the Carajás district would be 500 ppm copper soils are like not that attractive in that place. So if you were to talk to some geos who spend time there, they would tell you 1,000 ppm, which is 0.1% copper in soils, is something that is quote unquote, yes, we have to drill this, but targets below that are kind of, okay, we're going to see, maybe it succeeds, maybe it doesn't, right? Where on the other hand, imagine if you had 1,000 ppm copper porphyry target with that kind of anomalies and tenor, for example, in BC, right? What would you say the probability is that in the first or second program you're going to just turn up a 0 for every single hole? I think it wouldn't be that likely that you're going to get an absolute nothing from those holes. So that's again, I digress from risk analysis, and the first thing I said is position sizing, of course, and one other thing on the position sizing again that I forgot to mention, and I think maybe I should have mentioned it first. It also depends on how big your portfolio is, right? And the smaller you are, the more flexible you are. It's very simple. I am not that big, so I'm quite flexible, but at the same time, I think that, there are also situations where, compared to retail guys, I may be bigger than a good chunk of retail guys at the same time. But in serious business, that's still peanuts, right? But still, like our sector is so illiquid that at this point, even me, who is completely irrelevant, right? I have to watch out for how tight the stock is, and what would be the realistic time period when I can exit something if it requires exiting.
Right. What about board of directors? How much weight do you put on the board of directors in your investment decisions?
I would say it is right behind the let's call them facts, i.e. the asset itself and the data from the asset itself. Again, this doesn't have to be early stage, right? And I have a pretty good example here that I wanted to bring up to even before we started talking. And I think I saw you mentioning Thesis Gold somewhere recently. And I'll get back to the question. I'm bringing this up because Thesis Gold is not an early stage situation, right? And my gut feeling, and I don't know this for sure, but my gut feeling with Thesis Gold is that asset, especially now after the M&A, after it has been joined together, that asset would be valued a lot higher if it had different people owning it, basically, running it, right? So I think, for example, with that company, the problem is actually in the personnel, not the rocks per se. Even though there was a really good interview with Rick Rule recently, where Rick describes Thesis's situation as, I think he said, good but not yummy, or tasty but not yummy, something like that. He used the quote for his grandma or something like that. And so I see it in a very similar manner. Like it is definitely not bad, but is it like a dish made by a Michelin star chef? Not really, but it's definitely not bad. And there's a lot of gold there. It's in a quote unquote safe place yeah, it checks a lot of boxes, especially with the recent excitement from AMARC and TDG, right? But to get back to your question, I see this situation. And again, I'm not knocking on the company at all. I don't know it in depth that much on the people's end, but my gut feel is that the problem there is the personnel.
What's interesting, because that's something I came across when I was in Vancouver a couple of weeks ago, and it's the lingering effect of benchmark, and specifically the chairman. I think it's John Williamson. I think he's part of Metals Group. He's got a terrible reputation, and I'd heard some of that stuff before I'd made the investment, and so that there's a lingering. But those guys aren't involved anymore, and so I'm not. They still have a lingering effect, and that's sort of what I think a lot of investors need to take heed of, is like those reputations for management teams follow you, and whether it's failures, whether it's bad things that are done on the G&A side, whether that is lifestyle companies, it's hard to shake that, even when you have a guy like Ewan Webster, who's the new CEO, and he came from the thesis side. And I think Ewan is top notch, yet he is left with that lingering stench of poor management. And yeah, so I think you're at least partially right. Like, it's the lingering of the past board that definitely has maybe a certain portion of investors on the fence about them.
Yeah, so just one quick comment on that. I have heard about John multiple times, and I actually called some stock in a Metals Group company. But I just don't know. I would love if I could confirm yes or no right here. I don't have a problem with that at all. But I have heard about John multiple times, but I just don't know if it's him or the Metals Group per se, yeah, as I said, I don't know it in depth, but I'm just saying, based on my gut feel, that's I think where the personnel end of the equation is the key. I mean, especially with like what's gold right now, almost 2.8K, right? So yes, so there's that. But again, to get back to the question, the board and the people are right behind the technical things and facts. So I wouldn't hold at least a significant position in something that is just a people story. For example, somebody pitches you on maybe a Shell, maybe a company that is trading at 30, 40, 50 million, where they have an asset, but that they're privately looking for a new one, and hey, these are these guys with an absolute great track record, and maybe in the next 2 years they're going to acquire something that is going to be absolutely great. Like, I don't consider that a serious pitch. Even if the stock doubles, I don't really care. So I need measurable things, right? So the quick answer is it's right behind the asset. And there are, I think, there are many examples that you can find in the market where the people side of the story and the company you hear these things as well, right? You can we're not going to share stories here, but you can think of at least 2 or 3 situations off the top of your head that somebody told you about or you experienced firsthand, where you realize, like, holy crap, this is probably the wrong guy to be leading this company, right? And the way I see the board of directors is it's much more important than many retail investors think. Even if you have, let's say, one bad apple there, let's say it is 5 people, right? Even if you have just one bad apple, there may be some potential institutional holders that are going to say an instant no because of one bad apple inside your company. And that guy may not be even that relevant on the board, right? But it still is what it is. And it's exactly pertinent to what you said regarding the quote-unquote the lingering effect.
Right. In recent news, Newmont has been on a selling spree for the last 6 months. The most recent deal with Discovery Silver, they sell their Porcupine Complex for around $425 million. Big deal, and it's really interesting on the Discovery Silver side, but maybe not as much because of who the CEO is. I was wondering, what's your view on these series of sales from Newmont? Is this leading to an equally powerful acquisition cycle for them, do you think?
Well, the quick answer to that, just from Newmont's aspect, would be I don't know. But what I think about the moves themselves is they're doing exactly what they said that they would do, right? I mean, I wasn't that let's say, intrigued by this recent headline as much as I was by Newmont's sale of I mean, it's actually a Newcrest sale of Telfer to Greatland Gold, right? That was a situation that was really interesting to me because Greatland has been a situation that I have been following for, I mean, years at this point. But again, to not digress, to get straight to the question, what I would do in this situation with Newmont and Discovery, I would zoom out and then I would zoom in on the situation. Then I would zoom in on Discovery and look at their silver asset in Mexico, right? And to be honest, I do not think that even with the recent really bad mining-related headlines from Mexico, especially regarding open pits. I don't really think that is the main problem for her discovery there. I just think that their asset is just not high grade enough. Like it's not good enough. They likely saw this as a great opportunity to keep their company going and just acquire a tier two asset from a willing seller. That's how I would describe the whole situation.
The end of the year is so interesting from a number of standpoints. I think this year it stood out to me the most was watching some of the companies deployed options to themselves. What's your view on options compensation, the amount, the pricing, the timing? How do you view it?
I do. So honestly, I do not pay too much attention to it if it is something that is, let's say, in the acceptable range. And what I mean by this is I juxtapose that with just the size of the prize. I'm even willing to accept some let's say relatively weird compensation structures for management members if they're serious people, if the company is serious, and most importantly, if the asset is really serious. So I'm quite flexible here, but what I think pretty much anybody hates to see is option grants at let's say weird points for the company, right? Let's call it that way. You don't want to see those things. You would also prefer for the strike prices on those options to be somewhere in line with what investors get on their warrants, right? So that is also something that I would maybe pay attention to. But what I've found, and I think this is quite interesting for the let's say the principle of Pareto's law, or just simply put, Pareto's law. If you take, quote unquote, it's not my approach, but if you take my approach and care about, if you look at the people second and assets first, go just bottom up, you're going to find that usually very good assets end up with good or very good people. So instead of worrying about does a certain person have some kind of soap opera behind themselves, or a bad track record or a bad reputation or anything of the sort, try to worry about the asset first, and what you're going to find. And of course there are exceptions, of course, but what you're going to find is that very good assets usually are held by solid people, and it's just something that I've noticed in the last 3 years.
Right. In terms of picks, can you give us a couple of picks or companies that you think people should be looking at right now?
I mean, of course I can. I don't. Same when I talk to Trevor. I don't want to talk my book exclusively, right? But of course, I'm going to start from talking my book. And one of the really interesting developments recently was in Kazakhstan with the recent Aras Minerals news. The headline and the news release from yesterday wasn't as flashy, but it still bodes well, and it's good progress for what they have there. But the news release from 2 weeks ago was absolutely key for the company, and getting higher grades, or I mean, you can easily call 0.4% copper, 0.4 grams per ton gold high grades in that place where they are. So I would single out Aras Minerals here. I just think it's I think if you compare it to other early stage exploration opportunities, it's a high probability exploration bet that's right now on the market, and I think the market cap nowhere near reflects the potential upside. And so that's one that I would highlight. In second place, I'm not talking my book. There is a company in Colombia called Collective Mining that I have found to be a really, really intriguing success story. Whatever somebody, not you personally, of course, whatever somebody may think about the CEO or anybody else who is involved in or with the company, but I think Collective has been flying under the radar. I mean, especially the retail radar. For quite a while, even though the last 6 months have been really, really good for the stock. So I would say Collective. I don't own it, by the way, and we in our company, I think Collective is not even viewed that favorably just because of Colombia. But that would be Collective on second place. Do you have a limit? How many do you want?
Yeah, go for it. Go ahead, give another.
Yeah. On third place, and I also do not own it. I would put Hercules Metals. It's Metals now. I would put it in third place because there is. I'm not fully decided yet, but there is a certain probability that they have arrived to an inflection point for the project where it's a question of is the ore body going to continue to surface when you step out to the east? And if that happens, then it becomes a very, very serious situation. If it doesn't, unfortunately, I think what has been drilled off so far it's just not economic. And if somebody is going to argue with me on this, and I'm more than happy to hear the arguments, I would just say that Robert Friedland has about what's the tonnage of Santa Cruz in Arizona? It is, I think it's like 300 million tons plus, or 250 or something like that. So he has at 1 to 1.1% copper. He has that in Arizona underground, and Ivanhoe Electric is not really going up nonstop. And if not even Robert can promote this to that level, that it's like an asset that is being viewed as, hey, this is going to be a mine. Relatively fast, then I think if Hercules just stays underground, it's not going to be too attractive of an asset. And of course, the average grade there is going to be well below 1%. So they need to get something that starts to surface, and if that happens, then we have a very serious situation on our hands. I like where they are right now, so I'm highlighting that. And you may hate this, but I'm bringing up again very overlooked, and full disclosure, I am positioned here at a very low level. It's Thor Metals. It's a metals group company, and the reason why I like Thor is, first of all, nobody cares, right? And that's very cool. But they had trouble permitting their project in the Golden Triangle, and then once the company slowly started dying after that, they staked 2 new projects one in BC and one in Ontario, right? So it's a very Canadian story. But what I find unique about the proposition, and this is what the guys highlight as well. Not that I needed, highlighting of it, but they are actually fresh ideas. They're not putting something in front of you that has already been drilled. They're going to rehash some VMS in Quebec or something like that. It's not that. These are real targets and real exploration work being done. And both are relatively, to come back to my comment on operating costs for juniors, both projects, even though one is a BC porphyry and the other is a classic greenstone orogenic gold in Ontario, both are very, very easy to work on and very accessible, very cheap. And the targets in the current market, especially in Canada, I think they stand out. And we're going to get some more technical input, technical news releases soon, and hopefully the Colas, the BC Porphyry one, gets a permit in the near term as well. So that's also one that is completely, like, everybody even either doesn't know about it or maybe hates it because it's too low market cap. But I kind of like that one. Of course, it's not a big position or anything, but I did get it at pretty much bottom basement prices. So yeah, there is Thor as well. And I would like to mention a recent failure of mine, if that's okay. This is not on the positive end, but this is a company that can still pull out a significant success. I I didn't get a large position because it's a fairly tightly held stock and a company that has been run extremely well. It's Arizona Gold and Silver, obviously in Arizona with their epithermal Philadelphia project. And what I saw there is honestly similar to Hercules' situation. The project has arrived to a certain call it an inflection point, where if they delivered with the grades in the results from yesterday, it would be a completely different situation right now. But unfortunately, the first hole that they drilled into the boiling zone is just not high grade enough to move with the needle. It is continuously mineralized, over 100 meters of mineralization as expected, but the grades at like 0.38 grams per ton is just not enough. And of course, there is a lot more space to drill, and the target is quite big. So they can this can very easily turn into a success. But without that boiling zone, checking out with grades, I have my concerns about Philadelphia being a very robust standalone asset. So I did sell my not so big position, and actually I exited at a profit. And this also pertains to our risk mitigation and risk management that you and I talked about. I did sell at a small profit, and I'm really looking forward to what they pull out from put out from the rest of the program.
So even though you consider that a failure, you made some money. Did it teach you or reaffirm anything in your process?
In this case, no, because I would do the same thing all over again. Okay. And note that I think this is just this one. And of course, this may seem like a cop out or whatever, but I'm definitely don't shy away from beating myself up. But I think this one is genuinely a situation of bad luck. And you just you drill the right place. It is over 100 meters consistently mineralized as expected. The grade is just not high enough. And when you go maybe 50 meters to the west from there, the grade is like 1.3 grams. So I think this one is a question of luck. And did I learn anything from this? I would say no, because if you present the very same situation again, which is in a very short points, it's a cashed up junior ongoing drilling program, very important. As I said, inflection point for the project that can turn it into a very attractive asset, especially with the lack of exploration success in the US, right? Then you have, not that it matters too much, but you have the gold tailwind as well. It's a very favorable situation. And when I look at the geology, I was almost certain that, yes, it continues to the east, right? The question is like what the numbers are going to be. And in my mind, these are situations where you want to be in. Like, it's not a question of, does this thing even exist? It's a question of, how good is it, right? That's the way that I view this opportunity. So if there was the same opportunity again, I would probably do it.
Vuk, how can people follow you on the internet, whether it's social media or website?
So I don't have any social media other than Twitter or X. So it is just at Vukasin Pekovic. It's my name. And the other way to follow me is to be a subscriber of the Independent Speculator. And we have built up a quite a big database of companies that is primarily aimed at saving money and preventing people from losing money. And for the price tag that is being for the price that is being offered, I think that one is a bargain. While the higher end of the service is a personal preference, I think the access to the MyTake database is almost a must-have for most speculators and most retail investors in the sector.
Right. Vuk, it's been an absolute pleasure having you on the show. Hopefully we can do it again soon.
Thank you a lot, Brian. Thank you for having me.